there, my name is Kanina Court and I'm from Acorn Solutions. One of the things that I'd like to talk to you about is LAQCs, or Loss Attributing Qualifying Companies. You'll often hear people talk a lot about an LAQC, but a lot of people don't really understand what it is. So I want to dispel some of the myths around it. Firstly, before you actually look at putting in place an LAQC, you really should go and see a structuring expert. That's somebody who specialises in the area of putting you into the right structure, the structure that's going to fit your needs, your goals, and where you're going in the future, to make sure that there's a good match there. Often there's not a good match, so it is really important that you do invest in that and do it properly the first time. So an LAQC is just like a normal company, except the one special thing about an LAQC is that you are able to transfer the losses from the company out to the shareholders. Now the reason why you can do that is because of the status that the company has with Inland Revenue. For tax purposes, an LAQC is treated as if it's a partnership. And just like in a partnership where you have to give a personal guarantee to Inland Revenue that you will meet the tax bill, so the shareholders in an LAQC have to do the same thing. That's one of the downsides. If you were a shareholder in a company like, say, the warehouse, and the warehouse couldn't pay their tax bill, the last place that Inland Revenue could come to get their share of the tax bill is to you as a shareholder. But with an LAQC, you're the one that's first in line. So the good thing about an LAQC is that you can pass the losses out to yourself and offset those losses against your income from other sources, such as from your job. However, they are a short-term kind of structure. A property will generally bear losses for you for about 5 years, and after that it generally starts to move into a profit position unless you increase the mortgage on it. On that basis then, an LAQC is going to start turning into a profit after 5 years. If after 5 years you're turning into a profit and you're unable to pay the tax bill, then as the shareholder in the LAQC you're going to have to come up with that money personally. And I think that that's one of the things that a lot of advisors don't explain to people fully when they put them into an LAQC. So, what can I use an LAQC for? Well, LAQCs are generally used for investment properties where people expect that they are going to make a loss. Now, those losses can be good or bad depending on whether or not those losses come about through the property not generating enough cash to pay all of its expenses, or after it's paid all of its expenses, it's still got a bit of money left over, and then the depreciation comes through and that's what creates the loss. An LAQC can also be used for a business that you expect it's going to turn a loss for maybe the first couple of years, and after that it's going to turn into a profit. So again, the LAQC is very useful for passing out that loss to you as the shareholder. Some people will try to use the LAQC to put their house, the home that they live in, into a LAQC and then rent it from the LAQC. Please be aware that if you have received this advice, it is very bad advice. Inland Revenue take this sort of treatment of your home very seriously, and they regard it as tax avoidance. And if they find that you have done this, then they will come after you and they will get you with a very big stick. So obviously that's not a place where we want to go. People also mistakenly think that when they do transfer property into an LAQC, whether it be their own home or other property, that they can claim GST on their purchase price. Because residential rent is exempt from GST, you therefore cannot claim GST on your purchase price. So it therefore stands to reason that there is no GST applicable in any way, shape or form when you are using an LAQC, because of the nature of what you're investing in. If your LAQC was happening to run a business that was turning over more than $40,000 a year so that you're required to be registered for GST, then yes, you would be registered for GST and you'd be able to claim GST under those circumstances. So in summary, an LAQC is a very specialised type of structure that is very good in certain situations. It is not a one-size-fits-all. So please make sure that you get some really good advice from a structuring expert, and make sure that when you do use your LAQC that it's going to be the right entity for you. Thank you.